Hi guys. So what I want to do is pick up where we had sort of left off in class the other day, where we were looking at this in-class example that you see up here on the screen, and this was to help us to practice with our debits and credits, taking to us our various asset accounts. To increase it, we debit them; to credit them, to decrease them, we credit them. For our liabilities, to increase those, we credit them; to decrease, we debit them. Revenues, increase them, we credit them. Expenses, increase them, we debit them. Our stockholders' equity, increase, we credit it; decrease, we debit it, etc. And we went through that, and there's that one slide with those arrows pointing up and down that I definitely want to make sure that you are looking at and getting comfortable with. But this exercise is designed just to help us to see how we go from recording information in the journals, posting from the journals to the ledgers, and then we're going to see how we will then use the information in the ledgers to pull our balance sheet and our income statement. Now, this is sort of the old-fashioned way, even though we're using an Excel spreadsheet here, but this is really sort of the old-fashioned way. Now, state-of-the-art software would be that we would go ahead and put the journal entry into the journal, and the computer would post it for us. Okay, so we're going to go through this process just so that we understand what the software is doing. And in our next video, what we're going to do is I'm going to share my screen with you as we actually go through homework question and connect and see how we would use a general ledger software to, not this same problem, but do something very similar. When we have transactions, we're going to put them in the journals, and the computer is going to post them and then pull the financial statements for us. So, and that's how it would be done, these days. And then we will go ahead and practice with our quiz when we're back in class on Wednesday to talk about how we would answer quiz questions and ultimately, obviously, exam questions based on this information that we've learned here. Okay, so let's just go ahead and let's take a look at this, and I'm going to try to use my highlighter. I'm assuming that the computer is going to cooperate with me and let me do that. So let's just go ahead and let's start taking a look at some of these transactions, and we're going to start out issuing common stock for the company to start the company for $1 million. So we issue some stock to our investors. They give us cash in advance. So what happens? We debit cash. Cash is an asset, and over here I've put in our ledgers, asset equals liabilities plus stockholders equity. You wouldn't see that in the ledgers, but that is the case. We would have our ledger accounts that are assets, our ledger accounts that are liabilities, our ledger accounts that are stockholders' equity, and they would equal the assets would equal liabilities plus stockholders' equity. Notice I put our revenue and expense accounts under stockholders' equity, even though we'll be reporting those on our income statement. We want to see that they're ultimately going to affect my retained earnings. Revenues will increase retained earnings, expenses will decrease retained earnings, and we'll affect that by closing out our net income to our retained earnings. Okay, so we go ahead, we've debited cash, we need to credit the common stock. Common stock is an equity account. We just issued stock, we want to increase it, so we credit it, and then we would go ahead and we would post those entries. Debit cash. Now the balance in cash is $1 million, and then we would go ahead and we would credit our common stock. Where's our common stock? Right here. The balance in common stock is $1 million. Now I'm going to post these as we go along. You might do this at the end of the month or something. The posting would be done at the end of the month. I'm going to do it as we go along because this is how the computer would do it. It would post the transactions as soon as we enter them into the journal. Okay, so we go ahead and we decide to buy a building. And when we buy the building, the guy tells us, okay, you want to buy this building. The building is going to cost you, okay, now I seem to want to use my highlighter. Okay, there we go. The building is going to cost you $1.2 million. And we're sitting there saying, well, I don't have $1.2 million. Will you take $1 million and then I'll pay you the rest later? The guy says, sure, I'll take the $1 million as a down payment, and you can owe me the $200,000. So I said, great. I buy the building. Building's an asset, so I debit my building asset. I debit in the journal over here, and then I will post it into my ledger, say, at the end of the month or whatever. I would do that. Then what? Then I go ahead and I have to credit my cash for that $1 million. I credit the cash for $1 million. I don't have any more cash, but the guy let me have the building anyway, and he said, you can pay me later. I have a bill for that. I have a liability. I have a mortgage payable, and so that will be set up as a liability. Okay, so I've got my building now. I realize, I think we said we had a DJ business or something like that, so I realized, well, I need a vehicle to cart my equipment around. So I go and buy a really nice vehicle here. I need to show up in style at my gig, so I buy myself a Range Rover or something like that, and so that cost me $150,000. I don't have any more cash, but the guy says, that's okay. What you can do is you can owe me later on that. So I have another bill. So what do? I go ahead, I debit the equipment for $150,000, and when we say on credit, that means that what? That I have got like a credit card, a bill that I have to pay, and so I'm going to go ahead and I'm going to credit vehicle payable for this $150,000. So I've debited the asset. I'm going to post that. I've credited the liability. I put it in my journal, then I post it in my ledger, and our equation is still in balance, right? Then I go ahead and I provide service worth $200, and they pay me in cash. So since they pay me in cash, I go ahead, I debit cash, I credit revenue for the $200. So now I've got a revenue over here that I've just credited. So my revenue balance goes up to $200,000, and I have an additional $200,000 cash. I post that in my ledger, and now my cash is showing $200,000. But of course, I have to pay my expenses. I have to pay my DJs or my delivery guys or whoever it is that I'm paying to help me out in this business. And so what happens? I pay them $70,000 in cash for salaries. Salary is considered an expense. So I'm going to go ahead and I'm going to debit my expenses over here for $70,000. Debit the expenses. And I'm going to credit the cash. So now I'm down to $130,000 cash. Okay, now I've gone through and I pretty much have wrapped up my transactions for the year, and I'm showing these different account balances. But now the stockholders want me to pay them a dividend. So I say, okay, I've got to pay them a dividend. That's fine. So I go ahead and I debit the account dividend. Now remember, we were saying in class, dividend isn't an expense account. It's going to be reported on my statement of retained earnings as a subtract from my retained earnings, but it has the same effect on retained earnings as an expense, and that it's going to reduce my retained earnings. So I debit the dividend. I'm going to report that as a subtract to my retained earnings on my statement of stockholders' equity, or my statement of retained earnings. And when I report that there, that'll show a subtract to my retained earnings, so that my retained earnings will then show the balance that's going to be reflected in the balance sheet at the end of the year. So I go ahead and I'm done with my transactions for the year. And so I'm going to go ahead and I'm going to put together my income statement. I'm going to try to use my pen, and I'm going to try to do it right here as neatly as I can. And you know that my writing isn't very neat. Now I'm on the tablet, and I don't even have it in tablet mode. So bear with me as I go ahead and I'm going to prepare my income statement. Should probably put the income statement up here somewhere. This is my income statement, and here comes my revenue. Okay, and my revenue here is going to be, and I just go over, I find what the balance in revenue is right now. Don't worry that it says 0 down there. We've got some more journal entries we still have to post, but right now the revenue says $200,000. Okay, and I'm going to put those other journal entries in there later. Just pretend they're not there right now. But we go ahead and we have revenue, and the revenue is $200,000. There's my revenue, right? Just picked up that balance. How about my expenses? I look at my expense. Expense has a balance of 70. I know there's another entry there, but we haven't made that entry yet. Pretend. Just ignore that right now. And so I go ahead and I debit my expense. And that debit to expense is what? 70,000? Okay. And that's pretty much it that affects the income statement. So when I go ahead now and I show my income statement, I am now showing that I have net income. Isn't this fun, waiting for me to write this? Net income of $130,000. There we go. That's my net income, $130,000. Okay. Okay, good. So now I am going to go ahead and prepare my statement of retained earnings. Now I can prepare my statement of retained earnings. SRE, statement of retained earnings. That's my statement of retained earnings. And I have a beginning balance. Okay, beginning balance. And I'm assuming we just started our business this year, right? So my beginning balance of retained earnings is what? 0. I have my net income, and you don't show the arrow coming down like this, guys. I'm just showing you this for our purposes to understand. But if I was preparing the statement of retained earnings, I would certainly show an add. I would say add, ADD. Okay, add my net income. My net income is $130,000. And then I have an ending balance in retained earnings, and that ending balance in retained earnings is what? Is $117,000, isn't it? Okay. Now, I'm able to calculate my retained earnings here by beginning balance plus the net income. And might help if I show you how I got to 117,000, huh? Let's erase that. Let's do that again. Take 2 on that, guys, because I forgot to show you something important, which is going to be what? Less. And if I pay a dividend, that means I didn't retain my earning. I paid it out. And so I have to look at my dividends, and my dividends are how much? My dividends are $13,000 this year, so less dividend. Forgot to put in the dividend. Might help if I put the dividend in there to make this make sense. So I come out with my dividend of $13,000. That's a subtract, so I'm going to put parentheses on that because that's a subtract. Now, thank you, John. I have my what? Now I have my ending balance here, and my ending balance is going to be the 117. Okay, now I'm showing that here to you how we pulled our statement of retained earnings based on the accounts that were in our, well, we got our revenue, our minus our expense, that gave us our net income. Then we pulled the amounts that were sitting in our retained earnings, which had a beginning balance of 0. We added the net income, we subtracted out the dividends, and that gave me an ending balance of 117. But I don't do anything in accounting without journal entries. Okay, so even though I use what was in the account balances right now to show what my ending retained earnings should be, I actually have to put together journal entries that will help me to end up with that retained earnings. So what we call this is closing journal entries, okay? And so now we're going to close our revenue accounts, we're going to close our expense accounts. Why do we close them? We need them to be 0 at the end of the year so that they can start over next year. Think about that. Your income statement is sort of like your pay stub, and at the end of the year, your pay stub shows everything you've earned during the year, but at the beginning of the next year, it goes back to 0. That's how my income statement works. Obviously, you see the analogy for your revenues, but the expenses work that same way. I keep track of my revenues and expenses by year, so I need them to be 0 to start the new year. So that's what I do. I go ahead and I close them so they'll be 0. So now I start to make a set of closing journal entries. What do? I go ahead, I debit revenue for $200,000 since it had a balance of $200,000. Now it is closed. It's 0, right? I credit an account called income summary for $200,000. Now, income summary just sort of sits there and holds my closing entries, waiting for me to finish them. But by the end of the year, I'm also going to close out income summary because I keep track of my income by year as well. And I'm going to close it to retain earnings. But go ahead and let's close the expense account. So since the expense accounts had what? Had a debit balance of 70. To close that, I'm going to credit those 70. You see the credit here to expense. You see me posting that. Again, I make their journal entries in the journal. I will post them to the ledgers. That's what I'm doing here. And I debit income summary. And when I do now, income summary has this 130,000 credit balance sitting there. But again, I want to close the income summary to retained earnings because I want my income summary to be 0 at the start of the next year. So what do? Since it has a credit balance of 130, I debit it. I debit income summary. I would start over here. I keep sort of showing you from the ledgers, but I would start in the journal, debit income summary, credit the retained earnings, and when I post that credit to retained earnings now, it started out at 0. I just posted the credit, so it's 130, and then I want to close my dividend account. Why? I keep track of my dividends by year. So I'm showing a $13,000 balance in my dividends. I want to know each year how much dividend I paid out, so I want that to be 0 to start the next year. Since it has a debit balance, I credit the dividend, and I'm not retaining the earnings, so I'm going to debit my retained earnings. It's an equity account. To reduce it, you debit it, and I go ahead and I debit the retained earnings for that $13,000. I'm paying that out of my retained earnings. I want to reduce that, and now I have this credit of $117,000 sitting in my retained earnings. So now I'm ready for my balance sheet. Okay, I have to do journal entries to get that amount in the retained earnings, and those journal entries to get amounts in the retained earnings are called closing journal entries. Closing out the revenues by debiting them, crediting the income summary, closing out the expenses by crediting them, debiting the income summary. That essentially leaves me my amount of net income in the income summary. I close that by debiting income summary in this example, crediting the retained earnings, but then I have to pay my dividends out of retained earnings. What journal entry does that? Debit the retained earnings for the amount of the dividend, what was it, $13,000 in this case, credit the dividend, and that is going to close the dividend out to 0. And notice that all these accounts down here now are right where I want them to be to start the next year. They all have 0 balances in them, and that's what I want to be able to start this next year. Okay, but before I do that, let me get my balance sheet for my year 1. And so let's just go ahead and take a look at the balance sheet. And we have what? We have cash. We just start pulling the accounts right off of the ledgers like we did for our income statement. There we go. Cash has 117,000. Okay, it's tedious. It's easy, but it's tedious. That's why we have computers to help us with this. But it's pretty tedious, isn't it? Look at this little thing. How long we've been working on this already? It's just a little tiny thing like this. Then what? Then we have equipment. Here's my equipment. Equipment is going to be what, 150,000? Pick these up pretty easy. Just have to know, obviously, I should have probably said these are assets. I'm going to squeeze that in. These are assets, right? Cash is an asset, equipment is an asset, my building is an asset. Building is 1,200,000. Okay, I think that's it for the assets. Let me go ahead and add those up, and you know I'm not good with math, but I think the total of my assets, okay, the total of the assets is going to be 1,467,000. Okay. Okay, good. Sorry you weren't here to help me add that up. I added it myself, but I think that's right. 1,467,000. Now I'm going to show my bills, my liabilities, right? Got to pay these people back. So these are my bills. I'm just going to abbreviate liabilities. Okay, liabilities. And I have what? I have my, what do I have here? This mortgage. Okay, the mortgage is what? 200,000. I'm just going to put that down as morphed. Mortgage is 200,000. Got that. What else? We've got, I don't know why I keep looking down there. My sheet, I have it right here on my ledgers. That's where I'm supposed to be pulling it from. I have this payable, this liability on the vehicle. Okay, so I have this payable. Pay a bill. What's that? The payable here is payable is 150,000. Got that. Isn't this exciting? Any other liabilities? No, I think that's it. So I have my total liabilities. Are what, 350? Even I can do that one in my head. 350,000. Okay, good. Now I need my what? I need my stockholders equity, right? Let me get rid of that. Circle isn't helping us anymore. I'm going to get rid of that circle right there to give us a little more room for our stockholders equity. So now our stockholders equity, okay, we have common stock. Common stock is $1 million. And we have our what? Our retained, there's our common stock. Where's common stock? Just pulling it off the ledger. And we have our retained earnings is 117,000. Okay, that looks pretty good. 117,000. And so we go ahead now, and what, we have a total stockholders equity of 1,117,000. And you can check my math here, but I'm pretty sure that my total liabilities plus stockholders equity, when I just total those numbers, equals, and it equals the 1,467,000, which is the same as my total assets. It's like magic, isn't it? Whew. Okay, so what happens? We sit there and we just go to our journals, we post to our journals, we make the entries in our journals. Come on, John. We post to the ledgers, and we would probably do them periodically once a month or something. We were doing this by hand, but we were doing it as we went along because that's how a computer would do it. It would post it as we make the entries in the journals, post to the ledgers. Then what? Then once we've finished our activity for the year, we pull our income statement. That determines our net income. We can then look at our ledgers, prepare our statement of changes in retained earnings, statement of retained earnings, beginning balance, whatever it is, plus net income, minus any dividends if we paid that. That gives us the ending balance in retained earnings. Now we're ready to go ahead and pull our balance sheet because we were able to pull all the numbers that we needed either from our ledgers or from our income statement for our net income number. And we do that through journal entries, through closing entries. Close the revenues. Those were credits, debit them. Close the expenses. Those were debits all year, credit them. Close them to income summary. If we had a positive net income, income summary has a credit balance. We want all these guys that I erased the circle on here now to be zero. They all are. Right? All of them are zero. That's where we want them. Closed them all out, and now we go ahead and we close them out to our retained earnings, of course, and we are able to pull our balance sheet by picking up the account balance for our balance sheet accounts. Very simple process. Like I said, been around since the 12th century. We talked about that in class. And if it wasn't this easy, they would have abandoned it for something simpler already. Okay? Now, you come over and we start to look at year 2. Okay, now I'm going to spare you having to sit through me doing year 2 here on this video. We'll do this in class, okay, for year 2. But I want you to go ahead and take a look at this and see if you can follow what's going on. And one of the key important factors here, I say I won't go through it, and now here I go, I'm going through it. But notice that what? Notice that we have our cash balance here. Okay, we have our cash balance at the end of the year is 117. Our equipment is 150,000. Our building is 1.2. All our balance sheet accounts, right, still have balances in them. The balance sheet, remember I said, is like your wallet. So what happens? If you go to sleep on December 31st at 11:59, you wake up the next morning, 7 o'clock in the morning. If you had $100 in your pocket when you went to bed, you're going to have if you had $100,000 when you woke up, you're going to have $100 when you wake up the next morning. It doesn't change just because the year changes over. Well, since the balance sheet's like the wallet, you still have cash of what? Of the 117,000. Notice those balances carried forward, right? You still have the equipment of 150,000. That's the beginning balance. You still have the building. You still have the mortgage payable, the vehicle payable. Okay, now we're going to start to get into some of these other transactions next time when we're back together in class. So don't worry about some of these things that we didn't see before, because those started out at 0, and now this year we're just starting to make entries to create these accounts. But notice your other balance sheet accounts, common stock, your retained earnings, okay? Notice, and you wouldn't put beginning balance of 0 in my income statement accounts, but I did this just so that you can see that they are all 0. We zeroed them out last year so we can start to keep track of our revenues this year as we go along and our expenses this year as we go along. And you'll see that as we go into year 2. Okay? So I'm going to go ahead and end this video here. You should see another video next to this one here in Canvas that is going to now show you how we would do that question in the homework dealing with the journal entries and seeing how the computer will do this process for us, post them to the ledgers, and then go ahead and see how that generates the financial statements. Okay, guys? All right. We'll talk to you later.